All right, we are back on What the Funk. It is November 1st. That's not when people are going to listen to this. I'm not even totally sure when this podcast will be posted. Sometime in November. But either way, it's November 1st. Kind of feels like November out there. My kids have a whole massive bucket of candy in the other room that I'm probably going to have to hit up right after this podcast. But yeah, getting toward the end of the year, a little bit of end of year slowdown coming up, but no slowdown right now, either in the market or with general business. So really excited to have Josh Young on today. Josh Young may or may not know this, but I've been a fan of what he does. I think bringing some insight, exposure to oil and gas stocks, emerging companies, really kind of keeping a pulse on the oil and gas market. We'll talk about all of that stuff. But before that, I'll ask you the question that I ask everybody who comes on this podcast, and you can take this where you want to. Who are you? Who's Josh Young?
So thanks for having me on. And I do need to do first the disclaimer, which is none of this is an offer or recommendation or solicitation or anything like that. And if you take advice from podcasts or social media or various other things, you should spend some time looking in the mirror and really think about it. So maybe that's me. It's funny. I have this whole reputation on social media for not a recommendation. So it's not even a caution thing. I think it's just so important in life to really understand people's incentives and their motivations. And that's really, I guess like the pivotal moment in my life, and this is who I am, I guess. So I was visiting University of Chicago. My grandfather was a math professor. He had gotten his PhD and postdoc at University of Chicago. So I applied, I got in, I visited, and I stumbled upon a symposium in honor of Milton Friedman. And so, Milton Friedman, I met some students as a part of their prospective student thing. They were going to the symposium. So Milton Friedman came up with incentive theory. And incentive theory is obvious. It's people behave according to their incentives. But prior to Milton Friedman, for the most part, or at least they'll respond to their incentives even if they do things that are self-destructive, but they are aware of their incentives for the most part and they respond to their incentives. And so they had a symposium in honor of Milton Friedman, and before him, this was maybe like less intuitive. And one of the cool things about being innovative and brilliant is that you can come up with something that's new. And once you tell everyone, they're like, oh yeah, that was obvious and we knew that all the time. But
Right.
Really it started with you. So Milton Friedman started incentive theory, and I got to hear from him and a bunch of other Nobel Prize winners about it. And that's sort of, been a big factor, I think, in my life, both in terms of going there and in terms of, that always sort of being a guiding light in terms of how I invest and how I think about things and how I, who I interact with. And then even in, unpaid sort of non-economic sort of interactions, being clear about sort of incentives and sort of where people should or shouldn't, do things, or should at least be aware of sort of the potential conflicts or other challenges around incentives.
Interesting. So, I mean, really, incentive theory, it's about life, right? It's not just about finance or about business or about money. It's really incentives in life for each of us. They're different, right? We're all sort of our own unique beings, and whatever incentives we align to our beliefs kind of dictate who we are as people. So, yeah, I'm going to have to read that book. I've heard of Milton Friedman. Never met him, never seen him talk, but that sounds fascinating. I want to go back. So I think you told me you're from Los Angeles, but you ultimately went to Chicago. And now I understand a little bit more about why, because there is some family connection to that. So talk about a little bit growing up on the West Coast. Did you have any exposure to oil and gas when you were growing up on the West Coast? And what was that like going from, a warmer climate to having to wear winter coats in Chicago?
Oh man. So no oil exposure really at all. Didn't really know what I wanted to do with my life. Really loved history, was good at math. And that was actually part of the University of Chicago decision was, hey, I can go take the combination of history and math, and that's sort of economics. And so, social studies plus like sort of harder mathematical aspects. And I will say there was this funny moment where my dad mailed me a winter coat in October. So I started University of Chicago in September, and I emailed him and my mom. I'm like, hey, this is really nice, but man, this winter coat, it's from REI. It's for mountain climbing or whatever. This is, and it's puffy. This is probably a little extreme. I don't know that I'm going to need this.
Nice.
And 3 months later, I emailed them, hey, whoops, I'm freezing. So it was really, really tough to go from Santa Monica, 70 degrees every day, to Chicago. I mean, I think it was minus 20 or 30 or something on the coldest day when I was there. So it was pretty tough.
Yeah, you get that lake effect, which just makes everything super cold. I want to hit you with a question right now. I mean, I'll be asking you plenty of questions over the next 40-ish minutes, but if you had to take your pick, like which city do you like more? Is your heart more in Chicago or is it in LA?
Well, I'm sitting in Houston right now, and I live here. Between Chicago and Los Angeles, easily Los Angeles, just where I grew up and where family still is. And, I really liked getting to go to the beach and going hiking. And so, Chicago has a beach, but not really. Sort of like Houston has a beach, but not really.
Right.
But LA has the hiking. And then just sort of geographically, physically, it's really pleasant. The weather is pleasant. So those aspects are good. But both of them were really missing something, and that's beyond oil and gas. Why I'm here in Houston.
Yeah. We'll get into how you ended up in Houston and all of that fun stuff. But are you a Dodgers fan?
I've really fully adopted the Houston teams.
All
Actually,
right.
the biggest transition recently has been becoming a Texans fan. And this year, so I'm terrible with sports. I always sort of chose stocks instead of sports, even as a teenager.
Yeah.
But I don't even remember the guy's name, but there's a new quarterback here, and he's great. And, there actually being a shot at winning some games made it worth starting to watch a little. And so, I need to get like a Texans banner or something, because I started watching Texans games.
There you go. Yeah, CJ Stroud is his name, for the record. But that's cool. Not a sports fan. I am a big sports fan. If you were a Dodgers fan, I would say congratulations. Mostly congratulations to the Dodgers on beating the Yankees, which is what I care about. We always say like there's two. Yeah, as a Red Sox fan, right? Because I'm from completely the other side of the country from you. The two acceptable outcomes to the season are either the Red Sox winning the World Series or the Yankees season ending in heartbreaking fashion. So we didn't win this year, but they lost in a brutal way. So this was a successful season. I'll take it. It's fun.
As a Houstonian, an adopted Houstonian, but Houstonian nonetheless, I will say, it was time for us to allow some other teams to win a few World Series before we start winning again. So it's okay.
Yeah, people were talking about this on one of my calls yesterday. Like, this is the first Halloween we've had in a while where we can actually go out with the kids and not have to be glued to the TV to watch the Astros play. So I get it. I mean, it's been a thing. They've been awesome. It's kind of like a mini dynasty, or maybe even a full-fledged dynasty over the past 7 years. But anyways, this isn't a sports podcast. It's not a stocks podcast either. So just for the record. So you go to the University of Chicago, right? What was your major? Were you a math major? Finance?
I was an econ major. I wasn't sure what I was going to study exactly. Visiting, meeting Milton Friedman and Gary Becker and Bob Lucas and all these other guys. It was great to get to meet them and hear them. But I still wasn't 100% sure. But I started on that econ track, and it really made a lot of sense for me. So, but I think when I applied, I think I told the school I was going to try to double major in history and math. I think that was sort of where my head was at when I was applying.
Two distinctly different disciplines. I went to Brandeis. I was a double major in history and American studies. Those go hand in hand. And it was like an accidental major. Like history, you just needed to take 8 or 9 history classes. Whereas American studies, you had to have you have to take these classes. There's like Civil War. You have to take Revolutionary War. You have to take certain classes. So I worked hard to get my American Studies major done. And then I started doing the math. I'm like, wait, I might have enough credits to be a history major too. Met with a department head and they're like, yeah, actually, you have like 11 history classes or something. You were a major 2 years ago. I'm like, all right, cool. So I double majored accidentally. But yeah, history is something that I find fascinating as well. Any particular type of history that you enjoy, like East Asian civilization, U.S. history, financial history, like anything specific on the history front that you enjoy?
So my application to the University of Chicago, my essay was about the fall of the Roman Empire and different theories around that. So
Nice.
as a 17-year-old, I was super interested in the collapse of empires from economic and various other perspectives, and I'd say that hasn't changed. So it's been, I think things getting built and getting destroyed or really sort of failing are sort of the most interesting aspects. Whether they're, countries or businesses or people's careers or various other things. I think there's the inflection points, I think, are really the points that are the most interesting.
That's cool. I mean, we could go down, as a man, I have to be passionate about understanding the Roman Empire, but we can avoid that for now. Talk to me a little bit about your career coming out of the University of Chicago. Did you stick around Chicago? Did you go to one of the financial centers? Like, what did you do when you graduated? You're 22 years old. What was the next step for you?
Yeah, so I graduated really early. I was at University of Chicago for 2 years. I took off and went to Israel for a year and
Awesome.
studied actually in a yeshiva there, sat on top of a hill in the Judean hills and thought about life and tried to figure out what I wanted to do and what I believed, and traveled a lot while I was there. And then came back and I had a bunch of AP credits and was able to sort of test out of some stuff, which was part of why I decided to go to the University of Chicago. They would honor that when some of the Ivy League schools wouldn't honor, even if you got a lot of AP credits. They were like, yeah, that's nice. You didn't earn it here. Pay us. Right. At the time, it was 40 grand a year. Now I think it's like 80 or something a year. So they're really oddly tuition oriented. University of Chicago was not to their credit. So I was there for 6 more months and I finished in December of 2004. And then I think officially graduated shortly after that. So I traveled for a while. And then I took a job with Towers Perrin doing executive compensation consulting for a few months in Los Angeles. And I told them I was going to, my full-time job was going to be doing management consulting in Chicago for Diamond Technology, it was Diamond Cluster, as a technology and strategy consulting group. And so I told the Towers Perrin guys, hey, I'm going to go do this. Can I come work for you for a few months? They thought, hey, this is the best job in the world. So you're going to come work for us and you're just not going to follow through. And the guys in Chicago didn't care. They're like, travel, work, study. We don't care. Show up with a diploma and be ready to work 80 hours a week as a management consultant.
Oh, man.
So, yeah. So I did exec comp consulting, which was amazing. It was a great starting point, and it was really it tied in the incentive theory stuff that I was so interested in with business life. But actually, what really did it for me was I saw that there were these folks that were getting paid millions of dollars a year for being on boards of directors who were in their 30s. And there was not a path to do that from working at Towers Perrin doing executive compensation consulting. And so I was like, hey, I can go do that if I go do consulting, like strategy consulting with a big, well-reputed firm. And I can't really do that from Towers Perrin, so I'll go. And the one story I think you'll really appreciate. So I had a coworker who actually had come in at the same time as me from University of Chicago, who was at Towers Perrin. And so I quit and went to work for Diamond Cluster, doing strategy consulting, which was like, the thing coming out of school. It was like the most prestigious, even more than investment banking or whatever. It was like the thing to do in 2005. And my coworker stayed there. Also was sort of like angsty, right? He saw like, this was not like the way to the path to riches or phenomenal success. And he ended up leaving, partnering with my cousin, oddly, in some sort of like digital rights world. They were like helping manage artists. My cousin was an entertainment lawyer at the time. And he ended up leaving that, starting a long form ad business growing it, selling it for 10 figures, building, yeah. Or was it? No, not 10 figures. Sorry. 9 figures, I think. And
Okay.
then,
Well, only nine.
yeah,
All right. All right.
sorry, 9 figures. Yeah, yeah. I was thinking like, and then I think he sold it and then got to buy it back a couple years later because the people he had sold it to mismanaged it. And so,
Yeah.
it's sort of funny because I think if I stayed on, maybe I would have gone and like worked with him at this other thing. And so there's all these like funny, since we're talking about like life and life choices and stuff, doing the thing that you think is sort of best, or, following that path often, I've seen has actually not been the right way. And people that take those risks really do phenomenally well and have really interesting paths.
Yeah, I mean, I think we hear more about the phenomenal outcomes than we do the extreme failures. But I would agree, right? Sometimes taking the obscure path or the riskier path can pay off in spades. Um, yeah, fascinating stuff. As you were talking about that, it brought me back a little bit to like early career for me. I worked at a startup in Boulder, where I've lived for over 20 years, and I didn't know anything about tech. I didn't know anything about money, but I could sell, and they hired me on. I was the 11th employee of this company, and there were stock options. And long story short, I didn't like my boss, so I left and went to like a really crappy company. And it ultimately got me into oil and gas, which I think was a positive. But I look back on that and it's like, had I just stayed there, I never would have ended up in oil and gas. I probably would have been retired at like 30 because that company went public and then they were taken private through. So they had two like massive financial events. And I was so early at that company that my shares were really worth a lot, but I got nothing, So yeah, like I think a lot of us, if you're in the game, like you're going to lose sometimes in the game. And I think that kind of ties into Bison Interests for you. So let's jump into Bison in a minute. But first, I want you to talk about, all right, so after your sort of initial management consulting style gigs, you're still in Chicago, I think, at this point. Then what?
Yeah, so did the exec comp actually in LA, then went back to Chicago to work for Diamond Cluster. Cluster gets bought by Mercer Management, which was owned by Oliver Wyman, which was owned by Marsh McLennan Companies, which is this big publicly traded insurance company. So super weird. They have this professional services division in a giant insurance brokerage and consulting and whatever business. And so I saw that part of the appeal for Diamond Cluster was to go do these complicated strategy projects they were doing that were global and really interesting. And I was less interested in technology, much to my detriment, right? Like, hey, look at how the world has played out over the past 20 years. And that would have been, again, one of these like, really interesting paths. And so I ended up going to work for Mercer with the Cluster folks rather than staying with the Diamond folks. And doing strategy consulting. And it turned out that I really liked that sort of middle ground area where Diamond was so good at finding these real problems businesses had and then solving them. And when you're just doing the strategy part, there's like this big disconnect. And in many cases, I think the strategy is way worse if you're not the person that actually solves it or you're not really responsible. And so I think it's sort of one of these weird things where the grass is greener. It was like, hey, I was in the middle of like solving all these crazy projects for these big, insurance companies and some utilities and some other folks, and then flip to just pure strategy. And it's like, hey, wait a second, this is like absolute nonsense. And they thought so about me too. They're like, hey, you'd be a great partner, but you're a terrible, strategy analyst. And it's like, yeah, you guys like don't know how to think about this stuff. Like that's,
Yeah.
So that did not last long. So I figured that out real fast, right? It took like 2 projects. It was like, this is just garbage. Like the stuff you were telling people, again, like none of the people are still there. I think they've rebranded it 10 times since then, whatever. But this just doesn't make sense. You can't, no one's going to apply this. And there's no like, we saved while I was at Diamond at this one company, one project in 10 weeks, we saved them like $20 million a year. And they were stuck on this thing. They were using 2 business analytics, like business intelligence tools, which actually ironically has become this giant thing. And, is like, a lot of AI and stuff. There's LLM, and then there's also sort of the business aspect of it and the data analysis aspect, which is huge. and they couldn't get their like actuaries to switch from using, I forget which one it was, to the other one. And so I came in with like 3 other people, and we basically carrot and sticked them. And they, you bribe these guys with $500 gift cards, which I guess in today's dollars, post, Obama and Biden inflation, is like, $2,000 or something equivalent.
Probably.
Maybe more. Like, you think about a nice dinner in 2006 versus a nice dinner now. I mean, 3 or 4 times as much.
Yeah.
So anyway, so it was amazing to do that, right? It was so interesting. There was this big strategy and it had gotten stuck. And so there were some tactics and there was some adjusting the strategy, and we saved them just an unbelievable. We got everyone. It had taken 2 years and they hadn't gotten anyone to shift. We got the important, let's say 700 people out of the 2,000 needed to go. And then once we had them, we told everyone, hey, it's like turning off in 2 weeks. And we got the other 500 people, and whatever, the people that didn't matter so much or whatever. Once you had the important ones, and once you had the bulk of the people, the rest of it, they were just sort of forced to go along. And we literally, they were spending that much money just on the software and on the computers and the, all the sort of back end to support 2 systems, the licenses and the, the servers and whatever. And so it was really cool. I mean, we saved them just so much money, and then we actually did it 2 weeks early. So I then spent the next 2 weeks training all these people at this big insurance company on like pivot tables and on sort of project management. And I'm like, I think I was 21 still. And they're like training these 40-year-old technology executives at a Fortune 500 company about how to, plan and stuff. So anyway, that was one of the highlights, I think, of my career, was really just helping them. And then there were a couple other projects that were similar there. And they offered me a job at that insurance company in the suburbs of Chicago. And I was tempted, but it was just like not a great location. Honestly, they should have just offered me more money. I think they were paying at the time $60,000 a month in consulting fees to the firm. And I was not making that.
You weren't taking home 100% of what they were paying.
No, I was getting like under 10%, I think, of what they were paying.
Right.
They should have just offered me like 50% of that. Like, hey, I would have taken it. Like, would have saved them money. Would have, I would have worked as hard or harder or whatever, could have done it with stock options or various other things. And it's just not how corporations really think, especially about young talent. And so, it didn't make sense to me. I couldn't wrap my head around it. And, so I ended up not doing that. But that was a real big, I think I think about that sometimes, because I think there was room in that organization to grow a lot. And that would have been it was so great to have that sort of impact. And it's also great to have these people that like really value you, and where you're able to have, it's almost like product market fit for a new company, is to be able to find that sort of culture and that sort of fit. And so that was a really interesting, I think for years I tried to find sort of the equivalent of that from a career perspective, where you're sort of in the flow, where you're learning and adding value, and it's never sort of too crazy, and it's never too easy. And so I think that's really important, and that was something I found at 21 and had for a couple of years with that client before sort of moving on.
Yeah, that's neat. And still at this point, no oil and gas exposure whatsoever, right? So talk to me about like when did that happen? And when did you move to Houston? Like, how did this all start to transition? Obviously, you've got a big brain. You're a hard worker. You're starting to understand executive compensation, finances, numbers. Like, that's all sort of core to you. But then, where did Houston come from out of all this?
So there's a few steps to skip, and the reality is this is probably going to take too long. So we'll just hit a few of the highlights. So I had done some consulting. So some of the exec comp consulting was for private oil companies and a couple of, I think, publics that were relevant. So I'd seen sort of comp as well as sort of how that was set and how the companies tried to adjust for commodity price movements versus performance. And that's actually really important. Right now for Bison, we're working on, there's a couple companies where we're trying to make some changes from a governance perspective. And there's really this sort of weird delusion that, hey, our company had improving operating metrics in 2021 and 2022 and improving financial metrics. Therefore, we're good. And therefore, we should pay these executives lots of money. money. It's like, no, if your commodity price goes up, you do well. And then if when it came down, you did poorly, maybe that's not you. Maybe that's the price. And so, there's a lot of thought that should go into it. And when it's with private companies, I think there's a lot that does go into it. Public side, sometimes I think the boards are either they just don't have the background in oil and gas, and so they just don't know to look for this, or they do, and there's sort of this unpleasant sort of side deal or whatever, where hey, the CEO got me on the board, and so I'm going to make sure they're well compensated, and and that was part of why I left. That was it was great, but also in addition to wanting a sort of more impactful career, I also didn't like the idea of spending my days rationalizing overpaying underperforming executives, and so that. That's tough. So, so oil and gas. So I had been investing on my own since I was a teenager. I used to read the LA Times every day, mostly cover to cover. I'd skip the sports section for the most part. Sorry. But, started with the comics, and then, it'd be like the front page. And then I really liked the Motley Fool column. My mathematician grandfather, his wife, my grandma, was super into stocks. And so I'd read this column and I'd talk to her about it. And, she had been a stay-at-home mom and a substitute teacher before that. And she just loved stocks. She'd watch CNBC or whatever the stock channel was 30 years ago, 40 years ago. And we talk about stocks, and we talk about what I read and what she was investing in and so on. And somehow through that, I ended up investing in value technology companies and oil companies. And so I had been investing in oil companies in 2003 and 2007 and, at various points just personally. And so I think, let's see, so I did invest in size. There's a famous investor, his name is Monish Pabrai. He sort of oriented his investments around Warren Buffett. And I think he might actually be on Berkshire's board, or sort of he's next in line to join it or something like that. But very famous, got to know Charlie Munger really well and so on. And so anyway, so I was following him, and I actually got to meet him a few times. Really nice guy, very generous and smart. He got big in this oil company that was active in Venezuela called Harvest Natural Resources. And so you might appreciate this. You might know of the guy. He's very famous now. Morgan Housel was my intern at this private equity fund. When I left consulting, I went to work in private equity. I sort of liked that idea where I thought I could go find these companies at these inflection points and really sort of make a difference. It was the right balance between strategy consulting and the technology stuff, where I was actually involved in making changes and adding value. And so there was this moment, I don't know if Morgan's going to want me to tell the story, but there was this moment where I owned stock in Harvest and he owned options, and he almost retired in the summer of 2007 when there was some deal in Venezuela and Harvest stock went up 20% and his options went up 10,000% or something just astronomical. And, you won't read this in his Psychology of Money book that sold 100 million copies or whatever, but, this was very early on for him and for me. And so, I did really well in some early oil investments, and doing well in stuff is a really good way to get you to do more of it and to get your attention and get you to sort of like it. And so, I ended up selling that, fortunately, because, I felt like I had done better than I should. And then Chavez got scarier, and, generally, communists will eventually steal all your stuff. It's just sometimes they take a longer time. So anyway, that was my first real sort of oil investment win, and I guess sort of human interest story in terms of being there in the room as Morgan just absolutely, I guess you won't mind this story so much. It was just unbelievable, how well he did on this thing. And we were both just following Monish into this trade that ended up being horrible in the long run, right? It ended up as a zero, but we were able to get out. I think Monish actually got out too and did well on it, and sold before sort of it got really, really bad with the whole communist thing in Venezuela.
Oh, that's fascinating. Yeah, if I'm Morgan, I don't mind you telling that story, just for the record. But that's cool. So you're still pretty early on, right? You're talking over 15 years ago at this point. Were you in Houston? Is that what got you to Houston? And No, you were still in Chicago at that point.
No, okay. So if we want to get to Houston, so we'll skip. So I ended up working for a family office for a few years, doing investments mostly or increasingly in oil and gas, and running some of their energy exposure. I thought it was brilliant because I made tons of money after the financial crisis in oil and gas, and so I quit and started a hedge fund, which was stupid because I had never shorted stocks before. I had done well on the long side, and I ended up doing horrible because I didn't know how to short stocks, and I shorted this company Torchlight, and I shorted some other stocks that were just terrible but did well, and so that was bad. And did well on some of these side deals I was doing, and which was actually ended up being the bulk of the capital in a variety of different, some public, some private oil deals. Did some convertible debt that actually did really, really well, and then in 2015, after the oil price crash, the financial advisor for several, sort of coincidentally, because he didn't make these connections for me, I sort of met these guys separately, sort of these very high net worth entrepreneurial folks here in Houston I had met through different energy conferences and other stuff, had all invested with me in this convertible debt deal in a Permian focused company that I think it was traded in Australia. And so he was so impressed that we actually made money on an investment despite the oil price crash where things went from 120 to, we didn't go negative that time, but I think oil bottomed at like 20 something in, January or December 2014, January 2015. So impressed that we ended up starting an investment firm together. And the idea was, hey, let's not short stocks, both because I'm not good at it and because no one's really good at it from what we could tell. We looked around at different, long short funds and whatever, and, very, very few people were making money both on the long and short side in oil and gas. And since oil prices had just fallen, we thought, hey, we'll go buy oil and gas stocks when everyone else is selling them and everyone's doing private deals. So we'll go focus on public deals. And so, half that logic was good. It was a good time to buy oil stocks, but it was a better time to do private oil and gas deals. And so, we launched Bison. The idea was to do it in January of 2015, which was an amazing time to buy oil stocks. By the time we actually raised money, which is terrible. Like, you think you have $20 million lined up, people say they're in, and then you start and you have 500 grand, and it's your money and your business partner's money. And so even your best friends are like, we're in. And it's like, okay, where are you? And that's a very common, frankly, I don't know anyone other than people coming out of very large hedge funds that were somehow able to get backed by those hedge funds or something that has launched other than with their own money or close friends and family money. And usually it's sort of similar to our experience where that money followed over 6 months, but didn't show up right away. So anyway, as a part of that, it was way simpler from a regulatory perspective to both be in the same state. And then it was also, there was a lot of information I felt like I was missing out on trying to invest in oil and gas stocks in Los Angeles and in California rather than being here in Houston. And so the thought was, hey, instead of being in LA and coming to Houston for a week a month, why don't I come to Houston and then go to LA a week a month if I want to, or anywhere or whatever, save a ton of money on state income taxes, save a ton of money and headache from a regulatory perspective, and then also maybe do a lot better in oil and gas investing by being here. And I'd say, so far so good. And then there's one other thing I want to not forget, which is when I was spending time here but not living here full time, there were a few people I met who were just so extraordinarily kind that, they were the people there were people in LA who were really kind, but they were not very impressive from a work ethic perspective or a business perspective. And I met these people that were really hardworking and really good values and just noteworthy, extraordinarily kind people. And I realized that was sort of a value here that, they say be kind everywhere, right? But realistically, LA, New York, whatever, that's not a real, people will pretend to be nice and then talk bad about you the second you leave the room, say nice things and they mean things, whatever. In Houston, it's actually really a value. I really liked that. And it's hard because I'm from Los Angeles, right? But like I try, it's a thing to aspire to, and I really like that, and I'd say I've really enjoyed. I met my wife here.
Yep.
A lot of my closest friends are here, who I've met here. Some are local, some are transplants. But I think Houston, just the ethos, this expectation of being kind. I don't know that people are really different anywhere, but if you're expected to do something and there's incentives to do something, you'll do it more than you would otherwise. And so, it's really nice to be in a place where that's expected, that's encouraged, it's part of the culture, and therefore people just, if you have that idea, you act like it, and if you act like it, you are it. And so I really like that here.
Well, I love the way that you told that story, and it's got me thinking a little bit about, like, you need to leverage your quantitative analysis to make investments, right? In oil and gas companies. But I could see it being difficult with you being in Houston and actually meeting some of the people that run the companies that you're investing in or don't invest in, and not having a personal bias, right? Because it's like almost separating like the art from the artist per se. It's like, I don't particularly like this person, but their company's crushing it. Do I want to invest in that? Right? How do you avoid letting your personal biases or emotions, get in the way or not get in the way of your potential investments?
I think where I've actually messed up is not that at all. It's sort of the opposite. It's the stuff where I know I don't like them, but the stock's really cheap, so I buy it anyway, and that doesn't do very well. And it's funny because I don't want to say the name, but you and I have a mutual friend, and I may be actually investing a bunch more money in his thing, which is why I don't want to talk about it by name. But it's one of those things where it's the I've seen his tremendous success in doing something really similar, and you and I talked about this a little offline. And it's so easy to find someone who's done really well in something that is now doing something that's almost identical, and to bet on that and bet on the person. And where I get into trouble over and over again is finding things that are statistically cheap, that are, their value price and so on, especially in a sector like oil and gas where it's so out of favor. There's not like a rising tide. There was for 18 months or so. There's not really a rising tide to lift value price stocks. And so if you're not with the right people, it can really hurt. And when you are, it can really be wonderful. And so it's sort of actually been the opposite, where I've sort of been too good about like biting my tongue, ignoring my observations, and just buying the stuff that's cheap. And, it's something, frankly, we're fixing both by selling stuff where we don't like where the people are doing that, as well as by, in some cases, trying to change the people. So there's different people there who we can actually feel comfortable with betting on, and so on. So I hear you on that problem, but it's actually sort of funny. It's almost it's not exactly the inverse problem, but it's sort of the inverse of that I've experienced since being here.
That's awesome. I mean, yeah. And to what you're saying, right? It's sometimes, and I have a hard time with this too. It's like betting on the founder is the right place to put your money, even if you don't necessarily understand or believe in the product or the solution or the basin in the case of oil and gas. But generally speaking, betting on people is what's going to win, right? If you're picking the right jockey, like, that horse is going to race. And I think you're spot on with that. With Bison, what is your like overall investment approach? Are you just in buying oil and gas stocks in North America? Are you more diversified than that, betting on technology? Is everything surrounding oil and gas? Are you focused on the energy transition stocks? Like, where do you place your dollars when you're looking to invest?
Yeah, so I'll answer that. But first, just one carryover from our last conversation line. So one of the things I realized was, the thesis for Bison was, hey, oil and gas stocks are super out of favor. So along with oil and gas, so we'll go buy the stocks. And as a part of that, we turned down literally hundreds of private deals that our friends were doing and participating in. And again, it's one of those things you want to pay attention to, the things you missed, not because there are called strikes, right? You can't, if you do that, the Buffett says, no called strikes, and he's right. You drive yourself mad. But if you pay attention to where you're missing profitable investments, it's helpful because then it's not always done. Sometimes there's more. And so in the last few years, both for Bison, where we have just a couple, we've been extremely selective about this, and so far quite successful, as well as one that was so successful that actually got me to start having Bison in a small way invest in privates. Started doing private oil and gas deals. And that's been really, really successful. And again, something that's very new for Bison and very different from sort of where we started. And so that's like, a very tiny percent of assets under management, just because of like the setup for our fund, with quarterly liquidity and so on. It's not really something where you want to have too much of it in privates, but you can do some. And they've so far, again, been really great in terms of like hitting the various metrics. My hope and expectation is that they will do well from a financial perspective, but they're sort of early to be able to do that. So aside from this tiny percent that's in privates, we're focused on upstream producers in North America. That's the focus. And then where we can invest is anywhere sort of in that broader energy universe. So we have a few sort of fabrication and other sort of energy broad services stocks, a couple of rig companies, one pressure pumper, but for the most part are invested in upstream producers. Pretty much onshore US and Canada is sort of 80+% of where our money is at this point.
Wow. Yeah, that makes sense. And this has me thinking too, like, what do you do day to day? Like, what does your typical day look like? Are you like going out and raising money for Bison? Are you analyzing stocks? Are you reading various financial journals? Like, what does someone like you do on a daily basis?
I should be going out and raising money. There's this really weird thing where stocks are the only things that I'm aware of, other than maybe like, luxury handbags or something. It's sort of like luxury handbags for men, not to whatever. Men also can buy luxury handbags, but, where the higher the price is, the more people want to buy them. And then the lower the price is, the more people want to sell them. And I haven't really been great at sort of transitioning to the point where I can go raise more money at low prices. And unfortunately, people sort of treat Bison like oil and gas stocks, where it should be the opposite, where when stocks are cheap, you should want to buy them. And when they're expensive, you should want to sell them. And it's the strangest thing for me where, over almost 10-year period, and again, I'm not saying this to raise money or whatever, but we've way outperformed relative to oil and gas stock benchmarks, particularly the small cap one that were sort of directly measured against the small, like a PSCE as an ETF or S&P 600, whatever, which is a quality small cap. It's not the Russell 2000, which has a bunch of stuff that never made money and never will or whatever. We've done really well over time, and we've shown that after periods where we've underperformed or we way outperformed, we've got some of my buddies made this, framed this article from Barron's where we were up like 390% or something before fees in a year in 2021. So you'd think people would look at that and say, okay, hey, you're down X percent. Yeah, that's like not great. I don't want to be down X percent, but the last time you were down that amount or more, you were up this amount next. So, I'll connect the dots and I'll invest. And instead, all people do, as far as I can tell, is look at the latest, in the last 18 months, in the last 6 months, you've underperformed by this amount. And therefore, I will not invest in this, or I don't want to be invested in this anymore, or so on. And, I'm sort of being probably too broad and too general in that, but it's a very sort of weird psychological phenomenon. And I think the private equity funds deal with it by just having 10-year commitments and you just can't get out.
Totally.
Now you just can't leave, sort of thing. But that's not really fair to people in the public context. So I haven't exactly solved it. I've seen funds do it where they just operate long enough and have enough of those sort of trophies on the wall that people figure it out. And then I think the one other challenge for Bison is that most of those funds that have it figured out have large institutions as investors. And those folks are able to say, hey, we strategically invest in a few funds like Bison, because we know we're accepting short-term underperformance in various periods, and they might underperform when the market's up, but over time they're going to have this sort of these moments where they do extraordinarily well, and compounded they should do very well, and they add to our sort of risk-adjusted returns. So the math is there, but the folks that can do that math mostly are at institutions where they, one, don't invest in active managers in public equities, so they just don't do that anymore, period, because Einhorn said they, or sorry, not Einhorn, Swenson from Yale, his theory was to invest in passive indexes in public markets, and then invest in private equity and private deals. Or they won't invest in oil and gas, particularly in oil and gas public equities, or both. And so it's sort of this weird, amazing spot where the people that historically would allocate to this sort of strategy, especially with a manager that outperforms a lot over the long run, have sworn it off. And so it makes being in the business extremely difficult. And so basically it's a long way of saying, hey, I do very few fundraising meetings because everyone hates this stuff. But it also, I think, is part of how it's possible to outperform by a statistically improbable amount. Well, I should say in the past, right? Because past performance is not indicative, but to have outperformed by an index by, 5 standard deviations or something over a 10-year period, it's statistically impossible. You should not be able to do it. But you can do it if everyone that would do it isn't doing it, and the people that would invest in the people that are doing it have sworn for 10 different reasons to not do it. So anyway, day to day, what I'm not doing for the most part is fundraising meetings, because people, even the people that know they should, won't or don't. And so, it's very lonely, and that's sort of why we called it Bison, right? We knew there would be volatility, and we knew there would be significant fundraising as well as investment headwinds. And so the idea was, if you have a problem, if you have an issue, you win by facing into it, by embracing the suck, the sort of like startup type methodology, or face into the storm, and by doing it, you get through it safer and faster.
Yeah, I mean, this is really good stuff. I'm not like a big personal like stock buyer, stock picker, investor type. I have been in crypto for a while just because I had FOMO back in like 2016, something like that, 2017. And that's done extraordinarily well, but that was pretty lucky. It was just sort of like, I knew some people that were doing really well with it, but to buy Bitcoin when it was, 14,000 or whatever, look what it is today, right? That's like a statistical anomaly. But what I can relate to a little bit, and as we're heading into the weekend, this is when I do my daily fantasy sports lineups, is it's exactly what you're talking about. The players that you want to put in your lineups, especially in large field tournaments, are the ones that have been underperforming. Because if they have like a statistical basis for how they've performed in the past, the odds are they're due for a correction. But it's the hardest thing to do, to click on the underperforming name and throw them in your lineup. But if you do so, then you're going to be one of 2 or 3 people out of every 100 that's willing to take that risk, versus the hot player that 40% of people are going to own that has the great matchup. Yeah, even if you pick it, everybody else picked it too, right? So there's a lot of the game theory, I think, that you're talking about that applies to daily fantasy sports as well. And I don't know, do you play DraftKings or FanDuel or any of that stuff?
I don't. It's, again, just too similar to stocks, and I'm too addicted to losing money in the short term and making tons of money in the long term in stocks. And so, but yeah, exactly. And I think like the one other thing that I think is sort of similar, and everyone like talks about Moneyball and so on, but that sort of methodology where you end up with, when people don't like something, it'll get priced to a crazy low level. And so if you have something that that would have been cheap anyway, sometimes you can get it for stupidly cheap, and you can tilt your odds extraordinarily in your favor. And again, like, you'll look dumb for periods of time by doing that. And that's sort of the cost of doing it, right? Like, you pick the guy that looks funny and whatever, right? For the Moneyball thing, right? He found the guys that literally looked funny and were short and were whatever, and didn't look like, or were really like obese or something. and you win extraordinarily, right? Like, how do you get a 390% year? By looking like a complete idiot and being in the thing that everyone
Yeah.
is sure will never work. And then here we are again, right? Where the very similar to the statistical analysis you're talking about for fantasy sports. You can do these long-term analyses of stocks. If you're buying something, a friend from LA, Toby Carlisle, he does this stuff with like the founders multiple or whatever, very, very similar to that idea. If you look at stocks of companies that aren't over levered, that are at, let's say, less than 3 times EBITDA, and have been at that for more than a certain amount of time, so you're not at like the peak multiple, like peak of earnings, and therefore should be at the lowest valuation multiple. If you're not there, you end up massively outperforming the market over like a 5 or 10 year period. And so you have these small cap like oil and gas producers and service companies and similar at less than 3 times EBITDA. And again, everyone is its own thing. There's no guarantees. Maybe we are at a peak, although we're down 50% or something in oil from the recent peak. So probably that's usually a tell that you're not at the peak if you're down 50%. So it does look, it's I think in many ways similar, and then possibly even more extreme, where however much you don't want to lose your fantasy sports game and you don't want to do the thing that makes you feel bad, even more so for stocks, even more so where people are betting their retirements, they're betting other people's retirements, they're betting institutions, endowments and foundations' ability to pay. So they really feel uncomfortable. And the reality is that you have to outperform, you have to be able to do the things that make you really uncomfortable in order to do it. So that's like what I do day to day, is try to evaluate all these things, whether it's talking to industry experts or looking at the numbers and digging into the financials or reading the various reports or listening to quarterly conference calls or attending conferences, which is where you and I connected at one of these conferences. I think I was speaking at it 2 days before, but I just stuck around for the whole thing and got to listen to people. I think my favorite, I won't name the company, but they were talking about their brilliant AI solutions, and we're actually in some of their wells and they're underperforming. And so it's one of these fun moments where it's like, like, did your computer tell you to do that and mess up, or did you choose to? But either way, you learn so much from those things. But that's what I spend my time doing, and it's wonderful. It's like it's the great game, right? It's like trying to solve this just infinitely complicated problem, and you're going to get wrong repeatedly in the short term. And often you're just wrong, and sometimes you're wrong and you end up being proven right over time if you do it all right.
Yeah. Well, Josh, this is really good stuff. Like, I love getting into your brain a little bit, understanding, how you look at things. And I think that there's a lesson to be learned here to take some of the emotion out of it, because it is so hard to bet on a failing stock. But if you have conviction that it shouldn't be failing or that there's long-term upside with it, that's where you get your massive wins. And that's what people are betting on you to do. So good for you, right? They're not betting on you to buy NVIDIA at an all-time high. So kudos to you on that. Josh, where can people find you? Like, if somebody wants to reach out to you, check out your website, like, where's the best place to get a hold of you or to find you in the digital ecosystem?
Yeah, bisoninterests.com is a good place. We have some of our content up there, and contact us and so on. That's probably the best place. And then if you want to see my random ponderings, or I try to share various like media appearances and stuff, you can find me on LinkedIn or on X or Twitter. I probably post a little too much on there, but that's a good spot to see if you're less interested in the oil and gas investments and finance stuff and more interested in various random things. That's a decent spot to find me too.
Nice. And my final question. So you're going to the electric chair. You got 1 day to live. You're caught for like extreme fraud or something like that. I don't know. Or you kill somebody. Anyways, you have 1 day where you can eat whatever food you want in Houston. What are the 2 or 3 restaurants that you're going to in your last day before going to the chair?
This is a great question. So actually, I have a hobby barbecue oriented Twitter account that
Really?
only like my very most dedicated fans and friends and so on go on. It's I think what is it called? Like it's BBQ time or Bison BBQ time. I don't know, something like that.
Nice.
So definitely like if I've got one day, I'm probably going to Killen's barbecue and having their beef burnt ends and a beef rib. There and occasionally I think they have Wagyu beef ribs, and if they don't, then I'm going to Pit Room where they have more often Wagyu barbecue
Mm.
beef ribs, and that's honestly that's probably like I don't know that I'm going to have any room to eat anything else, and I think I'm okay with that. I think that's it. I'm good to go. Some burn ends, some barbecue beef rib, and good to go.
Well, I mean, you are now officially a Texan with that answer. But yeah, I mean, the barbecue down there is good. Maybe good is an understatement. But yes, I actually, for Thanksgiving, I'm going to order a Snake River Farms Wagyu brisket, like going above and beyond with that. And it's going to be next level. I can't go to an HEB like you guys can and just buy that, out of the freezer. So anyways, don't judge. But Josh Young, this was a blast, man. Thank you so much for coming on. Best of luck with all of the investments that you continue to place with Bison, and appreciate you being a flag waver a little bit for the industry, right? I think you're bringing exposure to the commodity space that's undervalued, that's sort of underinvested in, and it seems to work for you. So keep it up, my brother. Appreciate you coming on.
Thank you very much. And I'm going long funk futures. I see them in the background. So let's do it.
Thanks, man.